today's event with a great group of people like Alain and Anissa, who have funds, or Kim, who's been investing across, particularly with an impact angle, or Looney, what he's doing. Keep on hearing, and what I really like is a lot of connectivity from even though many of them are new, there's a lot of connectivity, which shows that this is that we're a good fit for each other. So having said all that, I'm gonna pause and then turn it over to you, Tino, who is an entrepreneur, and I really do want to help people like Tino, the entrepreneurs. But without further ado, let me turn it over to you, Tino.
Yeah, thanks. Thanks for hosting this, Mark. Having a champion like you among the entire group is awesome. Putting everyone together. So I'm elated to welcome everyone to this early stage venture and impact investment conference. The conference has two themes. Alan Hanover and Nisa Malls will cover the early stage venture investing and portfolio construction and how to de-risk that, and share from their experiences. And then the second theme is on impact investing. And so Kim Colt, Looney Leibus, and Catherine Griffin, they'll cover impact and how they approach it, how they measure it. And yeah, so I'm looking forward to learning what Alain and Nisa have to share about portfolio construction and mitigation of individual company risks. But I'm especially interested in what Kim, Looney, and Catherine have to say about impact, because my own startup is using a patent pending technology to eliminate the harms of global supply chains in favor of more profitable and sustainable hometown manufacturing. And so over the next 80 minutes or so, each speaker will have about 15 minutes to present and address any audience questions. We'll start with Alan. So Alan, his background is he is passionate about building and nurturing businesses. He's specialized in strategy, financing, and management in tech, software, medical, and green tech companies. So he was a founding managing partner at Castor Ventures. He's also a senior partner in a number of new sector-focused funds for the alumni venture groups. His background includes founding and scaling 5 companies, among them Common Angels, a Boston-based investment company, ViewLogic, a leader in electronic design automation, and other companies based on MIT technology and discoveries. So I think I saw Ellen there. So I'll hand it off to you.
Yeah, I'm here.
Okay, great.
Yeah, so given that this conference is about early stage investing, I thought I'd highlight our Basecamp fund. And of course, Basecamp is the first stage of climbing Mount Everest. And so this fund, AVG, Alumni Ventures Group, actually has 23 different funds, and Basecamp is just one of them that is early stage focused exclusively. And what we do at AVG is try to simplify and make investing safe. So, in order to reduce risk but still give you the best possible returns, we're highly diversified. In fact, the whole group last year was rated by PitchBook the most active venture capital firm in the country. And likewise, the Basecamp Fund is trying to be very active and do a lot of deals, a lot of small deals, to give you a very diversified portfolio. Here's an analysis that was done by a group. They just picked a certain probability distribution of outcomes, and the numbers they chose were 2% had a 50x return, 5% had a 20x return, 10% had a 10x return, 10% had a 5x return, 20% had a 2x return, 20% had a 1x return, 20% had a half x return, and the rest had 0x return. And with just those very conservative return probabilities, you can see that by simulation, a Monte Carlo simulation shown here, the more companies you invest in, the more likely you are to have a certain outcome. And of course, the very unlikely event, you'll lose your money, which is those kind of conservative. So we like this. Next. Next slide, please.
Oh, sorry. Sorry, Alan. Go ahead.
So why do we put together a fund like this? To, again, diversification. That way you don't have to pick. So we put together in 1 year about 100 high potential investments. We do very thorough due diligence to make sure they're all great companies. And also we check out the co-investors. I'll show you a list shortly. That way we essentially create an index. And, also we allow a very small capital requirement. So you can do this multiple years. So actually, if you stack up 10 years, you'll get 1,000 early stage companies. And then the odds of having a unicorn or multiple unicorns increases greatly, which increases your outcome, which is why on that previous slide, the more you invest, the better your chances are of having a higher return. Because the more you invest, the more companies you invest in, the more likely you are to hit a unicorn. Next. So that's our approach. Okay, so we have a full-time team of 8 professionals that are constantly sourcing deals by following every major accelerator, seed fund, entrepreneurs. We hang out. We hang out at the top innovation schools because we have 18 funds that are dedicated to the top innovation schools across the country that cover over 90% of the innovations or the patents across the country. So we have, through our alumni funds, we get tips on the best early stage deals that the fund can get. We make small investments. The fund is limited to 10 million. And we invest roughly 100,000 per company. So we make small investments in diverse deals. We reserve 25% of the money for follow-ons. So we want to chase the winners. And that way we can double down on the best companies for you and not get diluted too much, even though we will get diluted plenty as the rounds get bigger and the more money is raised by these companies. Next. So that's basically the way we operate. We give you a large portfolio, and we also make sure it's diversified. So we do every major sector, roughly in the proportion that the U.S. is investing in, because we're getting a cross section of deals from across the country. We have 6 regional offices, and we're involved with just about every major accelerator and incubator. And then, of course, we make sure we also have relationships with a lot of the VCs that we've co-invested with, and they recommend companies in addition. Okay, next, please. So here's an example of early stage companies that we invested in. They're all in different areas. We also tell you on our website who the co-investors are, so you can see that there's serious money in each of these besides ours. And the different sectors are different and so forth. Main Street, the last one I should highlight, is a platform for SMBs that helps them get government grants and monies. And in addition, this one was recently syndicated. I'll explain syndication next. Go ahead. So this is a list of some of the most frequent investors we co-invest with. And you'll see all the majors here, Techstars, Y Combinator, SV Angels, Koshler, Sequoia, etc. All the companies that are in the early stage sector. And so we co-invest with all these guys. Next. So one of the other things we do is we want to form a community. So we put together investors in a club. In a club, that means, it's not controlled by us. They get together on a Zoom call and they talk about the investments. When we syndicate a deal, so let me just explain syndication briefly. every once in a while, just like I mentioned, Main Street was syndicated when there's extra room in a deal. So we'll put in 100,000 or so, but if the company has a 500,000 room, we'll syndicate and let the other investors in the fund double down on that, or actually quadruple down on that one company by putting a bunch of money extra on that one deal if they like it. So it's kind of angel investing on the side, and then we can't recommend them, so we put the club together to let the investors talk about it and say good things or bad things or whatever they want to say about the company and make up their own minds about potentially getting involved in the syndication. When the syndication comes through the club, which means that fund is sponsoring the deal, then the minimum investment additionally is 10,000. So you can make side bets on companies as little as 10,000 through our syndications. Next. So here's here's more on the syndications. These are just 3 companies that we offered last year, and you can see the range of companies. Rigetti is a top quantum computing company. Temple Health is doing telemedicine, and which has really thrived in the post-COVID era. And Wasabi is offering cheap cloud storage for companies at a fraction of the cost of the big guys. So it's fighting Amazon and Microsoft and all those big cloud guys. And then, if you liked it, you can look at it. Actually, the best thing I tell investors is that when we syndicate a deal, you get to look at our due diligence, you get to look at our research, and you get an opportunity to look under the covers of why we chose the company and why the company's successful. Of course, we make you sign a non-disclosure agreement, so you don't disclose the information. That it's got to be kept confidential. But if you want to learn more about the company, it's a really good educational opportunity to learn about that sector of the business and why these guys think they're going to win. And of course, and if you want to then place a bet on it, that's up to you. Next, please. So, so we have a general fund. We actually opened the fund in the fall.
Alan, sorry, we don't allow pitching at our.
Okay, so I'll just skip this one. I'll skip this one. You guys can read. Okay. And then, so to summarize, we have a very well articulated policy of how we go after seed companies. We have a very rigorous due diligence system that lets us pick great companies. We scout, we literally have a huge network of both investors in our funds and also just our own professionals that scour the universe for the best companies to bring them to our investors. So with that, I'll stop and I'll answer questions.
Thanks, Alan. There was a question from Vinny Rao. She asked for an example walkthrough of dilution in early stage.
So typically, dilution, it depends on the valuations, of course, but you might expect up to between 20 to 50% dilution in multiple rounds of offerings in the company. So for example, let's say the initial round is done at a, obviously the entrepreneurs want a high valuation, but let's say the initial round is done at a 5 million valuation and they raise, let's say 5 million at that. And then you're 50% diluted right there because they're giving away half their equity. Then if you have the next round at say 50 million and they raise another 50 million, then you're again, half of your value is sold, so you're diluted. So it all depends on the valuations, both pre-money, how much is raised, which gives you the post-money, and and it's in how the company stage it. Many companies actually these days are using safes, which are convertible notes. So with typically a ceiling, so that way you can't get you can't have too high a valuation when it's converted, but And then the valuation is based on the next round. And you really don't know what's going to happen. So hopefully that answers the question.
Yeah, I think that, thank you, Alan. Why don't we take it to Nisa?
Sure.
Nisa, so the next speaker is Nisa. She's been in venture capital for 10 years at multiple funds at Scout Ventures and Grasshopper Capital, investing in general disruptive technology, starting as a generalist. And then more recently, she's switched to blockchain because she believes it's the largest technology shift of this century, and the sector from which the next generation of valuable companies will emerge. And so far, she's been right. In the last 4 years of investing in blockchain, she's had a return of over 100% gross. Nisa?
Hi, everybody. Thanks so much. I'm not going to run through a presentation on my fund. I'd like this to be a little bit more of a discussion. It was supposed to be around portfolio construction, but I will talk a little bit about the disruption that's happening in venture capital right now and how that affects portfolio construction. So I recently started what's called a rolling fund, and that means it's with AngelList, and Naval Ravikant, who was supposed to be on this panel, I believe, was the founder of AngelList and is setting out to disrupt venture capital. And with a rolling fund, in concept very similar to an evergreen fund, you are able to commit for a certain amount of quarters, and then you can roll off or you can increase your allocation. So it provides much more optionality for investors in venture funds. And for managing partners, it provides a way to simplify and automate your back end. So you're dealing with one service provider as opposed to, say, 4. How this affects portfolio construction. So typically, when I was at traditional venture funds, we would save about 25 to 30% for our pro rata in our winners. And now with the diminishing pro rata, or at least in the sector that I'm operating in, it's very competitive to get into these follow-on rounds if you're an early stage investor, as we are. So a lot of times there may not be pro rata, or there may be a liquidity or exit event a lot sooner than the typical 7-year or to 10-year time horizon in traditional companies or tech. So I think I'm on this panel to draw the distinction between what Elaine was covering, which is really a generalized fund, a spray and pray approach, allocating small amounts to each company, and my fund, which is much more sector specific, and we would look to allocate enough so that we could hold potentially 10% in the underlying company. So the mission of the current fund is it's impact focused. It's using blockchain technology to disrupt different sectors such as healthcare, climate change, supply chains, title, and legal tech. And while we adopt the tagline, crypto style returns without the regulatory risk, because I'm a securities lawyer and I'm able to risk manage a fund very well in this sector. We still believe that the value that's being created over the next, say, 3 to 5 years is going to be the use of the technology in these other sectors that are being disrupted. So what we've seen and what the headlines have shown with crypto is just the first use case and the disruption of traditional financial services. And now we are seeing the next wave of that through decentralized finance, non-fungible tokens, and now in impact. So the reason we set out to create this type of fund is we found that there were lots of impact funds out there already that didn't really understand the technology to be able to deploy to it. And then those that did understand the technology were typically setting up funds for speculation and trading of crypto. So, you know, from a portfolio construction point of view, we would allocate, say, 80% of the fund into impact type opportunities, and then have 20% be opportunistic. And we would still look to preserve our pro rata in that might be in the form of a token, or it might be in the form of equity, given the sector focus. And we would say about 25 to 30% if possible, if we could. So I'll stop and take questions if that's okay now.
Thanks, Nisa. Were there any questions for Nisa?
So it's interesting. You have a, you know, we like some little bit of point counterpoint. You know, and Alain's approach and your approach. You know, what we're trying to all do is steer ourselves to the top tier funds and investment opportunities. As families would like the flexibility. Alain probably sees a ton of deal flow. It allows you to cherry pick a bit. You do more diligence on a sector. Let's just let the crowd ask some questions, you know, just generally knowing that we're all trying to back the right systems and funds. So, and I might pick on you. Can I pick on you, Todd? Because you're such an active investor. Maybe you see it a third way, or you agree with one or the other.
You know, I really apologize. I got interrupted with something, so I was zoned out. So I don't know what the question.
You get a free pass, but you always do. But just, you know, Alumni Ventures sees a lot of deals. You know, allows for that diversity, whereas NISA, you know, does a sector focus. And, you know, I think you might even outdo everybody on your personal investing. You're sort of, I'd like to invest in Todd Rupert Ventures Fund, but what are you, what do you think?
I mean, I think the generalist approach and the specialist approach both work. It really comes down to your diligence and your ability to select properly. It's really the people that you're backing. But, you know, I'm invested, you know, for my own portfolio in a lot of fintech, ed tech, and media tech stuff where I think I've got some knowledge, but I've got some money invested in fintech focused funds or insurtech focused funds, but also money invested in generalist funds. So I don't think there's a right way or a wrong way.
And then you have the fund of funds, which you're sitting in one, right?
Right.
Others?
Greg Wallace had a question about the amount of time it takes to perform research and due diligence in the respective investment approaches.
I can take that. We spend about 6 weeks in diligence on each company that we invest in, and we have a 45-point checklist that we go through, very thorough DDQ. So.
Yeah, I should add that our process takes about a week to go through a company. We obviously get the company materials. We interview some of the other investors, or if they have customers, or if they have you know, partners. We also put together a very stringent due diligence report. We have a scoring system, and then if the company scores above 80, we invest, and if it's 79 or less, we don't. And in fact, we share that scoring when we syndicate the deal, so you can, if you want to individually angel invest in that company, you can see exactly how we scored it.
And we offer co-invest in syndicates as well and share our deal memos.
Thanks, Beth.
Okay, why don't we move on to the next segment where we talk about impact. Kim, I saw Kim earlier. Is she here still?
Yes, I'm here. Hi.
Okay.
Hi,
Yeah,
Kim.
so let me just do a brief intro. Kim is the founder and president of a company called For Good Ventures. It's a family office investment company backing disruptive, exceptional technologies, benefiting humanity and the environment. So investment categories include environmental technologies, health, education, financial accessibility, and diversity. Before founding For Good Ventures, Kim worked as an investment banker in tech, media, and telecom at Goldman and at Deutsche Bank. She got her degrees from Cornell and from her MBA from Wharton. Kim, I'll leave it to you.
Hi, thank you for hosting me, Mark and Tino, and it's a pleasure to be here. I'm excited about this community that you've created to bring family office investors of all kinds together. We're a family office originally based in Hawaii. After my tenure in investment banking, I spent some time thinking about the highest and best use per dollar for the impact that we could have. And that was really driven by taking over from my father, who had passed away, and really thinking through what would be the best next couple of decades for us as a family office in making a difference, but also creating regenerative capital. So we do philanthropy as well, and that's definitely important for the areas that capital, for-profit capital can't fill. But we also wanted to focus on a way where we could use a business model in a capitalist society to scale and get the level of transparency, as well as attract quality talent from universities by being able to offer equity, and fundamentally looking at technologies or systems that were close to becoming economically superior to incumbent technologies, and we're simultaneously solving some of the world's biggest problems. We believed with that combination, these would be the companies that really did the best in the future, because they would have to be. It was just a matter of time before we're going to inevitably have to make these changes. And, and that can be precedented by government or consumer demand, or a combination of a lot of external trends, which I think we're seeing now. So this philosophy was developed. It was really a thesis in 2015. For Good Ventures was the kind of umbrella created after we started formulating the thesis. We started with a heavy concentration on clean tech. I had personally gotten my LEED certification out of undergraduate, in addition to being an investment banker, because I wanted to make sure we were developing, hotels and resorts with the most sustainable systems available. And I also, through that, got to see how clean tech 1.0 didn't work out, and why, and the areas that ultimately were outsourced, and reliability issues, economic issues where they were just not meeting their standards, and why we're having these challenges now to overcome in the sales side, some of these opportunities to transform systems to becoming more sustainable, getting the trust again that they actually can be economically superior. And so clean tech, biotech, we hired different consultants and advisors in those spaces. We decided to do an outsourced kind of collective model, mainly because there are so many nuanced areas in those categories that require PhD level expertise. And either we would have a very large overhead on our own team, or we could partner with those who were specific to the areas of interest that we had most. And so it was this collaborative approach from the beginning that I think has enabled us to expand into several different other verticals over time by utilizing the right partner funds. We invest in a number of funds that support our same verticals, as well as consultants, advisors, some of which we pay hourly, some of which we bring in for small amounts of equity, depending on what their needs and long-term strategies are. So I feel very privileged for the network that we created, and that has been core, I think, to the success that we've seen in impact investing.
So what were your lessons from the not so stellar successes, Kim?
In terms of you mean for the clean tech 1.0 from the real estate adoption perspective?
Yes.
Like, for example, we had experimented with early stage electric vehicles, trolleys, and they would break down consistently. They were they had no ability to be serviced. They had, the charging was not efficient. It took really a long period of time, right? All of these things that we now have solved for and make them a convenient part of our lives. It was the first iterations of those. In terms of building systems, there were HVAC systems could pay more for that were more efficient, and HVAC, as most people know, is the largest consumption of energy in buildings, which is with heating and cooling. So looking at deep water, deep ocean water cooling systems where you're pumping up cool water to flow through the pipes to be able to offer a natural way of cooling. Then you have the infrastructure costs. And what we found there was, after each iteration of the new HVAC systems, they would become so much more efficient that by the time you had all of the capital and structure in the ground to do something like the cool water lines, it wouldn't, the ROI wasn't actually that great. So, I mean, these are two very simple examples of so many, but having that experience did let us know and give us some insight into what to look out for in this new run of clean tech. And
so what are those lessons? What are the takeaways?
What are some of the areas we're interested in? I think where software can complement new technology and hardware in a way that you can drive down efficiency significantly is of interest. I also, on the for-profit side, I think we're really focused on the tools that enable the rapid adoption of clean energy. And that has a lot to do with clean energy finance, as well as insurance. And those, if you can basically ensure a building is going to be able to reduce 15% of their energy if you spend the CapEx to make those changes, that takes away the risk from the owner of the real estate, the manager of the real estate, and puts it onto a third-party insurer. And now that we have the data and reliability of those systems, you actually can get policies for things like that. So the kind of the convergence of rapid adoption of clean energy systems, software, tech. I think it's a little bit harder to invest in the solutions themselves, but we are taking a diversified approach there, really leveraging the expertise of our advisors, which they've spent a long time in the space. These include advisors of, Breakthrough Energy Ventures, and some others, funds that are really well respected in that space. So.
Yeah, when you talk about convergence, that sounds a lot like Industry 4.0 and tying analog systems together with software.
Yes, And we've now expanded into other verticals as well, which I'm really excited about. Education being a big one. Education's being disrupted significantly, as people probably saw Coursera's recently announced to go public. But even in the early education and late stage education, there's transformations. And I think that's much needed for upskilling, required to keep our jobs and our people healthy as things become more automated. And traditional systems of vocational training aren't going to work. They certainly have had trouble during a pandemic. So we've seen the rapid adoption of other forms of, certifications and upskilling. Also, traditional education is so expensive often. So we're actively investing in that space and building out our network there. And we also, I think, finance for underserved communities, looking at different ways to evaluate people's ability to pay back loans, for example, new factors to determine credit that aren't discriminatory or biased towards, I guess I would say some of the factors that credit agencies typically look at to evaluate customer viability. They're limiting, and there are a number of companies, startups, that are looking at how do you look at what other factors enable someone to be financeable and build their credit and become productive, members of society by leveraging the tools that people should have to be able to accelerate their education, their careers, etc. So it's been, one of the things I like the most about impact investing is it inspires me with solutions every day, and I get to learn constantly. I get to work with great people because they all feel very, very passionate and they feel similarly. They're teaching me about, the entrepreneurs are teaching me about their perspective on, very specific topics and issues and how they think they can disrupt the space. And when you hear that, it provides a level of light and hope and excitement in life that, there are a lot of good people and they want to make a difference, and they will. So
I'm all for making a difference. Thanks.
There's a lot of questions in the chat. I don't know if you saw that.
oh
Yeah.
no, I wasn't looking. Hold on one second.
I'd just be curious, you've been on such a learning curve, you've developed your own sort of ecosystem, and we hope to be part of each other's ecosystem as we go forward, because, it takes a round table, the 360, but someone has to lead. It sounds like you've been partnering with some funds. You mentioned some lessons and for some deals. What are your, for family offices that want to allocate with an impact, how have you developed this network, and how can we partner?
I think I've developed the network both organically and proactively. Since I started this journey, I really have been putting in very long hours every single day, learning as much as I can and building out that network. We also made a conscious decision not to take LP money. So none of our time is really spent fundraising. And that enables us to really focus on the entrepreneurs and the community. We do have a collaborative approach, and that also helps enable trust, because we don't take any, if we'll put together an SPV for a company, for example, we have not taken any fees or carry, just expense reimbursement, with the idea that if we can bring the right people into these companies, they're going to add value, and we're all make the pie bigger, and we're all going to share in that together. Instead, just staying away from any potential conflicts of interest, with bringing money in for fees, and that doesn't work for everyone. We've been blessed that works for us. those, fees and carry are incredibly important for funds, for them to, attract and retain good talent and to be able to pay for all the overhead for their research and due diligence. So, but our main focus was kind of really building out the community in the space and helping as many others as we could in the bandwidth that we had do the same. So I think that just inherent trust and lack of conflict and collaborative approach has really helped build that community naturally as well.
Just one quick follow-up but do you also, it sounds like you had some partner funds. Are you investing as an LP into some of the funds as well?
Oh, absolutely. That's been a core part of the strategy, which has been working. So I highly recommend it. I would suggest dating the funds before you commit. There's, if they're doing well, they will have additional rounds of financing, but be able to see what their communication strategy is like, if they're delivering on their original kind of thesis. Get to know them as people, because also if you're more engaged, you'll get a lot more out of it in terms of your own learning experience. And so we're in about 15 different impact funds in very different areas. Everything from, very focused on the alternative proteins to, to health tech, to those that are focused on the future of clean energy. We're in credit funds that focus on like later stage clean tech companies, for example, and they take a credit plus warrant, and that kind of is less risky. I think building that out and building out that network, that deal flow, the expertise has been a really a good investment for us. And I don't think we could have done that if we were also raising our own funds. So, that's one of the trade-offs.
Carry on, Tino, sorry.
No, I think that's you've got a unique approach to investing, and it's the first time I've quite heard that. And aside from the typical spreading of risk across multiple direct investments and funds.
Yeah, we're taking a very duration approach and very varied in terms of the stage of the deals. And that's also something that, typical VCs are limited on. They usually have to specify a stage, an amount of ownership they want, how active they're going to be. They specify in advance how much, follow-on capital they're saving to invest in follow-ons. And I think that is, I've seen a shift towards saving more money for follow-ons, particularly in the impact space, because you want to double down on the best performers. And also it's, you're seeing demand from later stage institutional money, even soft funds coming in earlier and earlier in this space, because they realize how not overvalued per se, but how competitive it gets at the later stages, which is a great thing for the industry because it'll continue to push innovation in these critical areas. But I think in that sense, they want to be able to keep those follow-on rights as much as possible and partake in that upside.
So, Tino, can I just maybe, since I want you to know our community, Rich Sobel just made a comment. He's Rover Fund. They're doing an impact fund, more private equity. But this is Manus Bio, which the Gates Foundation is vested into. This is a company called Clean Fiber, which takes recycled material into an insulation material that helps people. That's a credit fund, WLC, into sort of healthy food and beverage credit, 12, 15% plus warrants. Everybody, it's a win-win-win, right? Nacero is taking a gasoline to natural gas to gasoline without refining. Huge carbon footprint savings, impact health, and I can go on. Some are not impact, but I just want to at least let people know how to connect on inside of, there's some success stories of our community. I'll stop my soapbox, but go ahead, Tino.
No, it's the duration comment, and the duration approach for equity investing was a fascinating comment. Now let's go into measuring impact. Looney is I met at he trains angel investors on how to select and measure for impact. So he's a 25-year serial entrepreneur. He's been a co-founder of 7 companies. So his latest 4 startups are all around how to drive investment into high impact companies without sacrificing financial returns. And so he also, he's a student of measurement, and he even wrote his own book on how to measure, compare, and aggregate impact. It's called the book's called the Pincho Impact Index. So Looney.
Hi, thanks for having me. And I'm not going to go that direction today. I decided to give you a more general review of impact than the specifics in the book. This is my bio. I do a lot of things. I spent 20 years in tech. I was a serial software entrepreneur, and I learned about investing in early stage companies by creating them all in Seattle, all backed by VCs in California, except the very first one, which was backed by a excessively wealthy person from Singapore, an angel who wrote a single check, the scale of VC checks. And then I made a big shift in 2012. I started a business accelerator called Fledge. It's impact focused. I'll tell you about that in a second. And it has a bunch of spin-offs. So next slide. Fledge is a global network of accelerators. So if you've heard of Techstars, which is a leading brand in the tech space, right? Techstars and Y Combinator. Techstars has like 50 programs running around the world. We're 6 years younger. We only have 8 programs running around the world, or 9 or 10, whatever, however many's on the map here. And we're impact focused first. So we're looking for companies that solve real problems of the world, that are young, and then we bring them in, we invest in them, we make them better. Next slide. What came out of that is the need for more angel investors, the need for more early stage investors. And so we last year launched the Angel Accelerator. And this year there's 3 programs running right now. One in the States run by Fledge, one in Africa run by our partner, Africa Venture Philanthropy Alliance. Nope, go back. And one up in Canada. If you're trying to learn more about angel investing, you can go to this website. Week 2 is tomorrow. It starts in 36 hours. If you're interested in joining, you can come in now. Next slide. And then someone asked about a middle way on the chat window between 100 investments and 10 investments or 15 investments. Well, we did a spin-off called Africa Eats, where we took 27 of our graduates from across that whole network, all in food and ag in Africa. And we wrapped them in what basically I just posted as the anti-SPAC, but I'm not pitching here today, so I'm going to skip that and teach you something about impact measurement. So next slide. And this goes back 100 and something years. It goes back to 1889 is when it got published, right? The idea is a little older than that. But this is the idea that Andrew Carnegie came up with, which is that the right way to do this is that you get rich and then you give it away. And I say it the right way, kind of air quotes, because that's an invented idea. Before that, the idea was you get rich and you give some to charity. But his idea was you give it all away. So next slide. And we know exactly what his beliefs were because he wrote it down in 1889 in an article in a magazine. It was called Wealth. It's now called The Gospel of Wealth. And you can read it. It's dated. But basically, that's where he's saying that if you die rich, you're doing it wrong. You should be considered a failure if you have died rich. You have to give it away before you die. Next slide. All right, so we have this landscape here of make as much money as possible and then give it away. Next slide. And what Carnegie did to do this was he created Carnegie Steel right when, perfect timing. Timing is most everything. He did this at the peak of the Industrial Revolution when steel was what was needed to build the railroads and the factories and the cars and everything else. He sold it to J.P. Morgan in 1901, which became part of U.S. Steel. Carnegie had more money than Bezos, Gates, and Musk combined. You can probably take, the equivalent would be take the top 15 wealthiest people in the country. That's the kind of the scale of the wealth he had. And then he gave it away. And he couldn't give it away by creating a foundation because they didn't exist. Nonprofits didn't exist because taxes didn't exist yet. Right? Income taxes came later. So he created a series of companies to give away the money. Most famous is the Carnegie Corporation, which funded 10,000, 20,000 libraries around the world. And most dear to my heart is Carnegie Mellon, which is a school that I attended as an undergrad. All right, next slide. So going back, and the consequence of this, of Carnegie's move, Carnegie's idea here, is that the big ideas, the big problems of the world, poverty, hunger, health, environment, whatnot, the consequence is we turn to the philanthropists to solve those problems. And we do that because others followed in his footsteps and they created foundations. And so we still have the Rockefeller Foundation giving away Rockefeller money. And if you go look at the list of the 100 biggest foundations, you'll find of the 100, it seems like 89 of them were entrepreneurial money, right? You find Johnson's money from Johnson & Johnson. You find, Ford Foundation. You find the creators of Eli Lilly and Merck and all these other companies out there. Their money turned into foundations, and those foundations are solving these problems. And we then just think that's the area that the philanthropists have to go solve, and they don't have enough money to do that. We need to use the for-profit means to go solve it because there's just way more money and more power on the for-profit side. I have a whole other talk on that. Next slide. All right, so I put these in the corner. Go to the next slide after this, because these are related. So we think of investing and philanthropy as two different things in two different pockets. We think we're supposed to go make money on Wall Street, and then we're supposed to give 10% of it away as philanthropy. But in fact, go to the next slide. They're on a continuum. And the continuum goes like this. Up and down is how much return do you expect? So when you invest, you expect the most return possible, or the most return given the risk as possible. And when you give your money away as philanthropy, you don't expect any actual financial return. It's 100% loss, right? If you think of it as investing, it's 100% loss. But the reason why you do philanthropy is on the next slide. And that's the horizontal axis, which is how much impact do you want to have? And we're using that word, the word impact investing is only like 15, 20 years old. The word impact has a lot of other meanings to it. But in this case, we just mean solving real problems. So when you put your money in philanthropy, the reason you do it is to maximize the impact and no return. And when you pick a stock on Wall Street, most people could care less what the impact is, right? Some people do ESG and whatnot, but most money out there in Wall Street, in bonds and whatnot, is just trying to make a return. All right, so the next slide shows those two axes. And the next slide shows where impact investing falls, which is pretty much everything in between maximizing your return and getting no return at all. Everything else is impact investing. And there's a white space down in the bottom left corner because, next slide, that corner means I purposely went out to have no impact and lose my money. Like, nobody chooses to go in that corner. We wind up in that corner because a lot of the things that we invest in as impact investors turn out not to have any, turn out to fail and therefore not have any impact. And so in the end, a lot of investments might wind up in that corner, but nobody picks that corner to aim for. In the bottom right corner on the next slide is what a lot of us call concessionary returns. So this is the idea. A friend of mine runs a fund in Portland called Beneficial Returns. It promises to return like 2% to its investors. Risk return wise, that doesn't make any sense. You wouldn't do that, except a lot of people do because of the impacts that they're making. They in fact spun up a fund last year that was pandemic mitigation, and they promised to lose 2%. So again, if you think of the frame as philanthropy loses 100%, and this trust fund that they spun up promised to only lose 2%, to give you back, 98% at best, maybe 95% of your money, that's a great investment as a philanthropist. As an investor, not so much. So then there's another corner in the top right, next slide, which is where my work is aiming for and my friends at Capri are aiming for. Capri is a network of impact funds around the world. We're trying to make money and have impact at the same time. This is the corner I also often called cake, right? I want the cake and I want to eat it too. I want a really nice return and I want a really good impact. And I want to get as far close to that top right corner as possible. But if I wind up in the middle, I'm fine, right? If I get my money back with 25% on top or 50% on top, right? If I can double my money, that's great. And have an impact, that's great. And then the next slide shows the top left corner, which is I want to have impact, right? I want to screen for impact and make sure my investments have an impact, but I'm not trying to maximize that. I'm trying to still maximize my return. And the best example I have for this is called IX Invests. It's a holding company started by the grandson of Warren Buffett. This is Howard Warren Buffett's holding company. I'm an investor in it because it's got a Buffett name on it. I'm really interested to see what they do. There's a whole bunch of funds in the impact space that fall into this top left corner. Okay, next slide. And to finish up here, we think of for-profits and nonprofits with that same lens. We talk about them with the same lens. We talk about for-profits exist to maximize their returns, right, to maximize shareholder value. I have another talk on that. And we think of nonprofits as philanthropists that lose their money. But next slide, reality looks like this. There are for-profits that are trying to solve real problems. There are nonprofits that are revenue-driven where all or most of their money comes in from revenues. They overlap. The overlapping area are hybrid companies sometimes that run both a for-profit and a nonprofit. And then the final slide here is impact investing can be into all of these. So just because it's a nonprofit doesn't mean it's not investable. Just because it's a for-profit doesn't mean it doesn't have any impact. And so the complexities of impact investing come from the fact that it's not one of these 2 points in the corner, it's this big wide landscape. And therefore it's really hard to describe, what is it that you're trying to accomplish unless you have a landscape like this and you can point to it and say, well, I'm aiming for this corner and therefore here's what falls out of that strategy. And with that, I'll open it up to questions.
I'll let everyone unmute and
I have a question, Looney. This is Mooncho. Thanks for that presentation. Loved it. Do you have an example of a company that let me start my video, that was so hugely successful in terms of the return and that had a huge impact?
Well, I made 105 investments through Fledge so far. We don't have time to go through all the successes, but I'll give you two.
Mm-hmm.
First one is in the Africa Eats plan. It's called East Africa Fruits. They've invented nothing and have done nothing innovative whatsoever. They buy fruits and vegetables and grains from smallholder farmers, and they sell them to retailers in the city. When we met the entrepreneur, year one, it was 100,000 in revenue, built on 4,000 of investment. By year four, it was $1 million a year business on $60,000 of investment. And then year six was last year, was $3 million. So our investment in that company is up. I don't remember if it's 30x or 40x, but some huge multiple. And I wish we'd put in more, right? One of those hindsight things. And another example is one that's not yet quite proven out yet, but 6 years ago, I had a student. I was teaching MBAs. She came into class one day. She said, my partner and I have a technology that makes cotton recyclable. And she's also explained over the years, it typically takes, like, rayon from being invented to being a mainstream product was like 20 years, 30 years. And so she signed up in 4 years. She signed up Levi's, Adidas, Stella McCartney, and Target as customers. There are Levi's jeans that were made out of old t-shirts. Literally old t-shirts melted back down, turned back into Levi's jeans, or jeans, right? Any cotton clothing. And they would have been out in the market, except there was a pandemic last year. So this will be a humongous success and a 100x return. And we'll make a huge dent in the amount of cotton we need to grow on the planet. And cotton is the most water intensive crop and the most insecticide using crop in the whole world.
Thank you.
Others?
Looney's got a
This
lot
is Roger.
of stories, actually. He's got a lot more to share. He's just
Oh yeah,
Roger's got a question. Go ahead, Roger Arjun.
Hi there. I take it with your style of investing, how do you think of exits in terms of pressure on the companies as you try to exit, especially when you have to compromise obviously the impact you're trying to make?
It's a great question. I have a book on that as well. I read a lot of books. So two answers. In the Fledge investment portfolio, we don't bet on exits at all. So we do what we call revenue-based investing. So we buy shares in companies and they have to buy them back. We bake in a 2x return on half of our investment based on their growth of revenues. And then the other half we get later. They have to buy that eventually. But they have to buy it back again in some other means besides them being acquired. Most places in the world don't have the virtuous cycle of acquisitions that we see in California, in New York, and Boston, a little bit in Seattle. I'll post a thing on here when I'm done talking. The VC style investing we see in California doesn't work in Chicago or Dallas or Atlanta. And it certainly doesn't work in Africa or Latin America or Southeast Asia. So that's a terrible, terrible model to follow if you're investing outside of Bay Area, New York, Boston, somewhat in Seattle, Austin, Texas. Second answer is in the Africa Eats portfolio, we took a page out of the Buffett plan. So we invested in 27 companies. We intend to own them forever. And instead of trying to find them acquisitions and exit those companies, instead we're taking the holding company public as soon as we can, hopefully by the end of the year. And then investors can come and go as they please. They can stay with us as long as they want. And then we can just keep growing the value of these companies and adding more in. And eventually we'll be public in a major stock market with hundreds of millions of dollars of valuation and hundreds of companies we've invested in. So those are the two models that that I've been using to avoid the method that I just call California capitalism.
But sorry to push back on the second one. I would guess, especially if they're non-US or non-Western European markets, IPO exits are A, long dated, and B, because of the weakness of many capital markets in emerging markets, that's not really a viable option. So
Roger, he's talking about his holding on an aggregate basis. Am I right, Looney?
Yeah, the holding company goes public. So just like Berkshire Hathaway is just a collection of operating companies.
Okay, with you. Thank you.
Right, and the Berkshire model, for those who aren't like totally keen on Warren, it doesn't pay you a dividend. Like there's a whole bunch of companies in there, BNSF, railroads, Fruit of the Loom underwear, See's Candies, Geico is one of their companies. These are companies, they do well, they grow at a nice, slow, steady pace. And Berkshire shares none of it with you. The way that you get money as a Berkshire investor is that the value of those companies go up, the value of the Berkshire shares go up, and if you want to sell them, you sell them. And if you want to give them to your give the shares to your grandkids, you give them to your grandkids. So we're building the same model. We're doing it in the emerging market.
Got it. Thank you.
I've got a quick question.
Akshay.
Hi, Looney.
Hi.
It was quite interesting what you were talking about. The chart and everything else. But how do you think about things like measurement? For example, you've got an Africa Eats portfolio. Let's say you're looking at 2 different African countries, and you could probably be doing the same, putting the same amount of dollars to work in 2 different countries or 2 different villages or whatever. How do you, prioritize one over the other in terms of how much further your dollar could go in each of those places, and how do you kind of report that back? Because there's so many new frameworks.
Yeah,
Everybody has an idea on how to measure impact and report impact, and how much more valuable their impact is over others' impact. So
okay, there's actually two questions in there. On the measurement side, both Fledge and Africa Eats reports 3 measurements. One is we simply report, somebody asked about the UN Sustainable Development Goals earlier. So we just take a histogram of which goals are our companies tackling. And literally just a histogram, 1 vote per company. Here's the space that we're in terms of impact. Does that interest you at all? Right. And every impact investor has a different goal. We did this at the Angel Accelerator last week. I pulled up the 17 goals. I said, pick your top 3. And out of 11 people in the room or 12 people in the room, there were 0 overlaps in terms of people picking the same 3. They picked 16 of the 17 goals with 12 people, and none of them had more than 4. Second thing we measure is gender. So we all know about the systemic gender issues in venture capital. We're at about 1/3 in our portfolio of women companies. We would love that to see half. There just aren't that many women companies to pick from. And we don't go out of our way to pick them because they're women. And then the third one is we use the Pincho Impact Index, which is boils down, it gives you a number for your portfolio of how impactful it is. It takes about 10 minutes to produce. I'll throw that URL up in a minute. What's interesting about that, I invented this in 2014. Again, it takes 10 minutes to produce. And we thought back then that that's what everybody wanted, was a single number that you could point to. And it turns out it's not what anyone wants. So I highly recommend the book and then ignore it. Because once you have a single number, now you're thinking about impact in terms of numbers instead of stories. And what makes people want to do impact investing is the stories. And then the other thing you had in there was, how do we pick companies? How do we pick the ones with the highest impacts? And the answer is, we source everything through the accelerator, which means we get hundreds of choices at once. We get to compare them head to head. And it comes back, our criteria are team impact and odds of success. And impact is just scale of impact. So when I hear of Evernew, which is the cotton recycling company, with a global potential, like this could change the way we touch 1 million acres on the planet, change the way that the entire fashion industry works, right? Cotton is like 1/3 of all of fashion. That's the biggest potential impact I've ever come across. So then we have to go look at the team and the odds of success. But in terms of impact, that just trumps everything else. And same thing when we saw ArcLight, which is a plastics recycling company. Like, plastics is a problem in the whole world. This is a global problem. That's huge. Versus one that we brought into Fledge was deploying toilets in Kampala. Like, it's a problem, but it's never going to get past Kampala. Like, it's an important problem. We need to solve it. But we know that investing in this company is not going to grow to the scale of Uganda or East Africa. It might get to 2 or 3 cities at most, but it was probably only going to get to Kampala. And there's scales in between, national scale and regional scale and city scale. And when we get a village scale one, we just skip it. It's too small.
That's great. And thanks, Looney. This is a perfect time to segue into Catherine and how she developed a method of measuring impact. So for the last 10 years, Catherine's worked at the intersection of finance and social impact, elevating investability of social enterprise and using the data to quantify impact returns on investment. So she led an award-winning social impact accelerator for 7 years prior to founding Impactable X, where she sets the standard for financially integrated impact modeling, management, tracking, and reporting. So the analytics enable investors to do due diligence on impact claims, allocate capital for the greatest impact returns, and then seamlessly track and analyze those investments' performance over time. And so her work's been featured by Forbes and the New York Times. So Catherine, I'll let you take it away.
Thanks, Tino. And I want to thank Akshay for that question. So I'm the founder and CEO of Impactable X. We work with both founders and CEOs, as Tino mentioned, to quantify, model, forecast their social and environmental impact in a way that is compatible with financials and really brings impact analysis and reporting to the standard that we're all accustomed to on the financial side. And we do so in a way that is super user-friendly for the founder. I'm going to tell you more about how we do that. But first, just to give you a little bit of background, as Tino mentioned, I was the managing director at Good Company Ventures, which was an early stage accelerator for social entrepreneurs. It was award-winning. We worked with organizations like Bloomberg Philanthropies, Wharton, the Obama administration, and several others, and had sort of multi-sector partners involved in mobilizing, accelerating, and launching early stage innovations that could address really long-standing social and environmental challenges. And because of all of the different stakeholders involved, it was really critical to sort of have a bottom line analysis of the impact returns on their investment in this program. And we worked with hundreds of entrepreneurs, and we just saw how difficult it was for them to quantify impact in a meaningful way. Early stage companies often, of course, lack data, lack time, lack resources, and many of the other approaches were extremely expensive, were strictly retrospective. So they did sort of an impact accounting, which early stage companies sort of de facto can't do. They need a forward-looking projection that engages investors around the possibility and potential that their investment capital can unlock. And so this is sort of an initial mapping of some of the other players in this space. And you'll see sort of on the y-axis, early stage at the top, public markets at the bottom. And then on the y-axis, you see sort of a range of sort of broad goals and standards all the way down to very sort of granular data collection work. And so I'm sure you're all familiar, with the Sustainable Development Goals, Impact Management Project, and sort of these large sort of standard setting organizations, and they're great. But a lot of times they're goal setting, right? They're very high level. And so how does, an early stage founder or an investor how does someone on the ground actually doing the work identify what to measure in order to understand the degree to which they contribute to a high level goal? And so we saw sort of really the need for a user-friendly, very practical impact modeling approach that helped early stage companies to quantify, like I said, quantify, model, and forecast their impact the same way they already do on the financial side, which is to say, where they're lacking primary data, you make some initial assumptions, and then you put measures in place to refine those assumptions over time. I'm going to talk a little bit more about how we do that. If you'll go to the next slide, I want to talk a little bit about our theory. So a lot of people ask, what is social impact? And so when we talk about it, this is what we mean. Just sort of based off of first principles, right? Entrepreneurs solve massive problems. Social entrepreneurs solve extremely massive problems that have persisted for ages. Solving big problems creates massive value. Entrepreneurs figure out how to create and capture some portion of that value, but revenue only reflects the portion of that value that can be monetized. And so we see additional value that's not monetized, and we consider social impact as unmonetized external value. And so what we do at Impactable X is help them to capture the full value of their innovation. If you'll go to the next slide, please. Just sort of thinking about it in terms of dynamics. So a purely financial model values internals, right? A business model works if it captures sufficient revenue to make a profit and reward investors. However, a social impact model integrates externals as well. A business model works if it also creates leverage for impact, maximizing external value creation per dollar of revenue generated. And so our whole approach is about building the social impact model and really understanding how a business model works to drive impact. We don't see these as siloed. You don't have, revenue on, one end of the spectrum and impact on the other. We see these as very much integrated for-profit social impact companies. And so it's really critical to understand the relationship between revenue and impact creation and the dynamics that drive it. If we'll go to the next slide, please. So this is really just a quick run through. Looney touched on a lot of these points already, but social impact is no longer just a matter of altruism. According to Deloitte, this is really about marketing, it's about retaining top talent, and it's about building loyalty among customers. On the next slide, it says that 86% of millennials consider the business practices of the companies they support. And if you go to the next slide, the impact investing market is massive and it's growing really, really quickly. And among impact investors, on the next slide, it says that 100% of them consider impact metrics to be critical. So just want to respond to a point that Looney made earlier, which is that, yes, it's about storytelling. But if you're an impact investor and you're considering, 5, 10, 100 different investment prospects, how do you make a decision about where to allocate capital for the greatest impact leverage? Stories are great. Hold on for just a second, if you don't mind, before we go to this slide. Storytelling is great, but impact needs to be much more than about, curb appeal. What does the research and data say about the ability of a business model to drive impact? And what are the different, dimensions within a model that drive it? And so we think that it's really critical to ground stories in data and research. And what we do at Impactable X is build models that provide sort of dynamic, modular, I'll tell you more about this, but sort of a static framework within which companies can evolve their inputs, their various assumptions about their sales and revenue, their impact percentages, et cetera. And then generate analytics that give investors exactly what they need to understand about impact creation per dollar of capital invested. So I'm eager to hear your questions, but I'd like to share with you a little bit more about how we do what we do and provide an example of a company report so you can see this work in action. So if we go to the next slide. So our methodology is really simple, and I've outlined the kinds of analytics it generates. So there are 3 components to it. In the first step, we define a company's impact metrics. We always start with the work that a company is doing on the ground prior to aligning with the SDGs or other impact taxonomies. Oftentimes we see a bit of a disconnect. Sometimes founders have this down. Sometimes this is not as clear. But typically we work with 1 to 3, maybe 4 key impact metrics. Then what we do in the second step is we break down a company's business model and we quantify impact on a unit level. And when we quantify impact on a unit level compared to a baseline in a specific geography or with a specific demographic, now we can then extrapolate to understand impact over a given term pursuant to sales and revenue projections. So we model impact creation on top of sales and revenue projections. And this second step generates impact outputs or outcomes. So the quantities of a given metric based off of, the sales projections of a company. So this would be, pounds of trash diverted from landfill or tons of carbon abated, et cetera. And then in the third and final step, this is where we assign an economic value to impact. We're looking at cost savings or new value created as a direct result of the impact of a company captured in the second piece. This allows us to differentiate between a company that's serving 2 people at a deep level versus 1,000 people at a shallow level versus 1,000 people at a deep level. This also allows us to differentiate between companies that are doing, work in South Africa versus, work in San Francisco. So we try to make this as place-based as possible. And then once these 3 components are complete, we're able to generate a total impact value projection and impact multiples, like an impact multiple of revenue and an impact multiple of capital invested. And so on the next slide, this is dynamic, it's modular. The framework itself is stable, but the inputs to it are variable. So, the baselines, the unit level impact, the sales projections, these are variable. Similarly, the cost savings or new value creation, that's variable. We keep the metrics the same. We usually keep the baselines the same. But, when we are initially working with a company, we're often working with limited primary impact data because, they're new to this, they haven't known what to collect or how. And so we build a model for them that then evolves over time as they get smarter about their products and their companies' work. And so the inputs to this framework also evolve as they grow, which then of course generate updated analytics. And so when we work with a company, we produce a certified company report, which you'll see on the next slide, which is good for a year. And fundamentally what we're doing is we're relating revenue to impact. And when we do that, of course, that's based off of the inputs that informed it. And so we want to make sure that the relationship between revenue and impact is as sound as possible. And so this is just a snapshot of a company report. This was a company that was providing simple text-based reminders to people on probation and parole to show up for their hearings, which is a disproportionate driver of recidivism. And so we worked together to identify the impact metrics that were of value. And then, we worked on a per site basis to identify, you'll see on the left-hand column, all the baselines. And then on the sort of, column B, if you will, the quantities and, also sort of the percentages that this company's work could impact on a per site basis. And then what we do is we look at the cost savings associated with that. So if one more person shows up to a hearing who wouldn't have otherwise, what are the cost savings associated with that? And based off of, the average number of people per site and the total number of sites, a company projects to sell over a given term, we're able to extrapolate out to look at total cost savings, based off of the sort of difference they can make. And then that rolls up to these summary analytics that I outlined before. And so, here you see just a snapshot of one company. But if as an investor, you have a portfolio of companies, now you're able to start comparing. The revenue multiple represents, which business models are the most efficient drivers of impact. And the capital multiple, of course, talks about, where to place your capital for the greatest impact leverage. So you get, and then of course you have, total impact value projection as well. So you sort of have the basis for a really comprehensive analysis and insight into, investment prospects. But happy to stop here and take some questions.
Yeah, it's the top of the hour, but I think a lot of people were enthralled by this.
Let's let a question or two go.
I have a question.
Mm-hmm.
I want to, and it combines a little bit of what Catherine said and what Kim said. Kim, in your presentation, you brought forth how you invest in people and you disrupt a little bit of the traditional way of investing. And then Catherine, I love what you're saying about how you put a valuation to the impact. What I want to know is, Kim, when you're looking at opportunities to invest, how much weight would you give something that Catherine produces versus other metrics, or like you said, investing in a person versus all this quantifiable work that is reflected in the metrics that Catherine provides?
I'm not sure Kim is on.
Oh, I don't know. That would be very interesting. So like Catherine, I'm wondering, do you work, can you make some reference to that?
Yeah, I'd be happy to. So we do work with impact funds. We work with them in sort of three capacities, but to answer your question, what we'll do is work with companies on impact due diligence. So they'll perform their sort of traditional financial due diligence, and then they'll hand it over to me. And
got it.
I'll sort of vet the claims that a prospective investment a founder has made around their impact, to ground it in research, ground it in data, understand to what degree they're able to back their claims, to what degree the research backs their claims, and then actually put some numbers around it, which then tees up the sort of other two services which we do, which are around tracking, impact tracking over time, integrated with financial, tracking of performance, and then also reporting. We work with impact funds to generate an impact report on, on an annual basis or so.
Great, thanks so much. I'm looking forward to talking with you.
Likewise.
Other questions?
Yeah, I have one. This is Doug Zingale. Some years ago, I worked with George Overholzer on designing some new securities where we were borrowing venture capital concepts and putting them to the work of venture philanthropy. The idea was to introduce a lot of similar kinds of discipline, but with no expectation or possibility of return. And for Kim and Catherine, I'm interested in whether you've come across this, whether you know how widely it's being used. I know that George is still out there swinging the bat, and just any thoughts you have around that. I'm curious.
Yeah, so venture philanthropy is definitely expanding. More foundations are making PRIs, where they're able to, invest, a portion of their holdings in social entrepreneurs. And so, that is definitely a category that early stage entrepreneurs are now pursuing as they're raising capital. Typically venture philanthropy is more on sort of the impact side of the spectrum that Looney articulated. There's more sort of expectations of concessionary returns.
To the purpose, you mean, right? Not to the funder.
Sorry?
I was wondering when you said we made that reference to returns. When we were doing this, the idea was to just keep recycling the funds. They left the system. That's what you're talking about, right?
That's exactly right. Yes.
All right, great. Thank you.
Anyone else?
So, Catherine, just a quick question. Good afternoon, by the way. It seems to me that because you're doing overlays on metrics like revenue and things like that, that you have a very specific point at which your work gets done most of the time. Or is that wrong? And you can basically apply, some of this work, whether it's, kind of a lighter version, if it's pre-revenue or whatever. So I'm just curious about, when most of your work typically gets done in terms of stage, and whether or not you have some other predictive work that you might do in advance of, when a company actually gets to that kind of typical stage.
Yeah, absolutely. It's a great question. So typically, first of all, this work can be done at any stage. It was designed with early stage companies at Good Company Ventures. So these were typically companies that had maybe a proof of concept, maybe they had a pilot lined up, but they did have revenue projections. They had put some numbers down on paper around, pricing, their markets, market penetration, how much, they think they could sell to whom. So it is important that that is in place. But whether or not they've actually begun to generate revenue is irrelevant. And, we think that at an earlier stage, this can be really informative for a founder and their investors to design business models that maximize for both revenue and impact. That said, most of the work that we do today on a day-to-day basis is with companies that are, have raised some seed capital and are seeking, Series A, all the way through companies that have raised, Series C level capital. So we can work with a company at any stage. And even if they do have revenue, even if they do have primary impact data, we can still, do some predictive work. And we can do retrospective work. So because we model impact on top of sales, we can look at sales to date and generate impact actuals to date. And similarly, at any stage, we can look at, 5, 10, we even work with a company around energy storage that's doing a 30-year projection, because a lot of their investors are looking at carbon abatement 30 years out. And so we can model out as far out. Of course, it becomes more attenuated over time. And of course, when you're working with an early stage company, it's, entirely assumption driven. So it's incredibly attenuated, but we liken this to financial projections. And so while no investor would hold an early stage company to their 5-year revenue projections, no investor is going to take a meeting with a founder who didn't have them. And so it becomes really interesting to have a conversation about, the impact expectations that a company has and the degree to which they've really thought about the impact mechanics of their company, especially when, they're mission driven. This is the sort of reason for being for a lot of these companies. And so we help them really build that story and understand those mechanics so that when they sit down with an investor, they have a really solid case to make.
So Catherine, if I could, Torin Kutnick, do you know Torin? He's on the screen.
I don't.
2 years ago, we had our first impact conference, and in the Q&A, he was like, how do you measure impact. And that's sort of what Michelle does, and to some extent, Allison. Well, first of all, I'd love for you to join us on the 24th, and measure. Maybe we should even make one of the panels about measurements. I'd be curious to get everybody's dynamics on that. But I think what you do, you fill a real gap, because they do these, public markets, private equity. What about, I was at the family office. We'd try to get quick assessments. We do appraisals. Do you do something that's sort of like, sort of a verbal, without doing the full report, to sort of think that we're in the ballpark, and then you do the confirmatory, the full report? What's your process?
That's really interesting. No, we don't do something like appraisals, though we could. Our process is very streamlined. So on average, this takes like 2 to 4 weeks. What we do is we get on an intake call, we define a company's impact metrics, we understand their business model. From there, we begin a process of collecting primary data or assumptions based off of their stage of development, and both baseline and valuation research. So it's a combination of third-party research and company data. After that, we compile an initial report, and then we format the final report. So it's pretty streamlined, and we're sort of also evolving as a company to bring in AI and other things that can streamline it even further.
Like Eddie Vonderpark, I'm just thinking, as you look at deals, if you add this methodology, or you do to some extent, but maybe you could, I'm looking for
I actually just reached out to Catherine on LinkedIn while we were talking, and she is multitasking, so immediately accepted. I really want to talk to her about doing this.
She's really good. She's doing that, right?
So I think this is fantastic. And my question is more, is there, if you go one extraction level higher, is there a sort of a almost like accountants do, a sort of a standard that people like yourself set, to which people can then be beholden to, or a common methodology that you and other people use? Because that would be even better if that would be the case over time.
Okay, so 2 things. So one, there are standards that are recognized among the global impact community, the SDGs, IRIS plus core metric sets or taxonomies, and the impact management project's 5 dimensions of impact, which basically tell you like what you need to be measuring. Our work aligns with and builds off of each of those standards. So any investor in the impact space is going to be satisfied that the work that we produce aligns with their approach. However, we also produce certified company reports. So when we work with a company and we complete this process with them, they receive a certification mark that says our impact data and analytics have been vetted by a third party. We are still pretty early, so we need to build brand recognition around that mark. But we often get contacted by investors that say, I saw this mark, I took a look at this report, I want to learn more. Where did these numbers come from? Like, tell us a little bit more about you. And so it's absolutely enabling founders to get the attention of, engage with investors. And we hope to get to a point where our certification mark will be recognized like the B certification as setting the standard for rigorous impact analysis.
That's great.
Well, we don't have to use them, but we do have breakout rooms, which you all have the ability to go to any room that you want without me assigning you, or we could stay here in this town hall. But if you wanted to go deeper into what Libby's doing, or Catherine, or Tino can tell you about his company, or all the rest, as you wish. And Tino, hats off, great event.
This was great.
And, we'll have more on this. Obviously, there are different ways to try to optimally invest in venture as well as in impact. So let this be a, part 2, part 3, part 4.
Yeah, it's been a ton of fun. I've learned a lot. And
A very good event, Mark. Well done.
Great.
Thanks, everybody.